Welcome to this explainer. Today, we're diving straight into exactly how to calculate your Scope 1 emissions, and we're going to do it using real Pakistani data and practical everyday examples. Look, if you're a business owner, a sustainability officer, or in finance, you already know the deal. The phrase carbon footprint is not just some trendy corporate buzzword anymore. It is a hard, non-negotiable metric. International buyers are demanding it, you need it for export compliance, and local banks are increasingly looking at it before they offer any green financing. The pressure is absolutely on to get these numbers right. But let's be honest, the actual process can feel completely opaque. So we're going to strip away all the jargon today and make the underlying math incredibly straightforward. Okay, let's start with the real question on every business owner's mind. How do you actually cross the bridge from raw, chaotic operational data to one single audit-ready number? I mean, you might literally have a desk right now covered in faded fuel cards, messy generator logbooks, and crumpled delivery receipts from your fleet. You know Scope 1 means direct emissions, but making the jump from that massive pile of physical paper to a standardized, globally recognized environmental metric, it can feel like an impossible leap. Well, we're taking that leap together today, step by step, and we're going to completely demystify the whole shebang. Just as a quick refresher for anyone joining us, let's establish our foundational ground rule. Scope 1 simply equals the emissions you burn yourself. Basically, these are the direct emissions from sources that your company physically owns or directly controls. If you're the one putting the fuel in and burning it, boom, it's Scope 1. Think of that diesel generator roaring in the back of your facility, the company trucks making their daily deliveries, the heavy boiler in your factory, or even the gases escaping from equipment you maintain. The rule of thumb here is super simple. You own the equipment, you control the fuel, you own the Scope 1 emissions. Let's move right into Section 1, the core formula, the mathematical engine behind carbon calculations. So everything we're talking about today builds around this one single powerful mathematical equation. No matter how massive or complex your operations might be, this foundational math never changes. You simply multiply your activity data by an emission factor to get your total emissions in CO2 equivalent, or CO2e. That is literally it. That's the entire mathematical engine behind every single carbon footprint calculation you're ever going to do. And just to clarify, CO2e is essentially a universal currency for greenhouse gases. Since different gases heat up the atmosphere differently, CO2e just converts them all into one common, easy-to-measure metric. Now, the formula itself looks incredibly simple, right? But your accuracy as a company depends entirely on the quality of the data you plug into these two variables. And this breaks down the two halves of our equation beautifully. On the left side, we have your activity data. This is simply how much fuel or material your company actually consumed. We're talking the physical liters of diesel, kilograms of natural gas, or tons of coal. It's your raw, real-world consumption. Then, on the right side, the emission factor is a standardized database number that tells you exactly how much CO2 equivalent is released into the atmosphere per unit of that specific fuel. Now, the reason we use these standard factors is to completely eliminate guesswork and, more importantly, prevent greenwashing. You don't just get to invent your own emission factors to make your company look more sustainable. You have to multiply what you actually burned by the globally recognized standard of what that specific fuel releases. Which brings us to Section 2, 4 emission source categories. Where Scope 1 emissions actually come from. Before we start plugging numbers into our mathematical engine, we need to know exactly where to look for them, right? Notice how these 4 distinct categories map perfectly to real Pakistani business examples. First up, we have stationary combustion. This is fuel burned in fixed, unmoving equipment. Think of a major textile mill in Faisalabad running heavy diesel generators during grid load shedding. Second is mobile combustion. This covers any vehicles your company legally owns, like a fleet of delivery trucks running the highway route down to Karachi. Every single liter of diesel they burn on that journey counts. Third, we have fugitive emissions. Now, these are the tricky, sneaky ones. It's not combustion at all. It's gases accidentally escaping into the atmosphere, like refrigerants slowly leaking from your office AC units or industrial chillers. Beginners almost always forget these, but they are absolutely Scope 1. Finally, process emissions. These are highly specific and come from chemical reactions rather than burning fuel. For instance, the actual chemical process of manufacturing clinker at a Lahore cement plant releases CO2 directly from the raw materials themselves. All right, Section 3, calculating ABC textiles, a full worked example. Let's take all of this high-level theory and see what it actually looks like in practice. We're going to build a scenario using a fictional, mid-sized garment exporter based in Faisalabad. Let's call them ABC Textiles. First, we need to gather their activity data for one typical operating month.
So after auditing their facility and checking the back office records, we uncovered two main sources of Scope 1 emissions for them. We see they relied pretty heavily on backup power this month, consuming 5,000 liters of diesel to keep their factory generators running and production lines moving. Plus, their logistics team reports using 2,000 liters of diesel for their fleet of company-owned delivery trucks moving finished garments to the port. So we've got a clear, precise activity record to start with. Next, we need our precise emission factor for diesel fuel. Pulling from standard, trusted conversion tables like the Greenhouse Gas Protocol or the UK DEFRA guidelines, we find our factor for diesel is approximately 2.68. What this means is for every single liter of diesel burned, 2.68 kilograms of CO2 equivalent are released. Now, I want to share a wild, surprising fact about that number. A single liter of liquid diesel only weighs about 0.84 kilograms in your hand. But when it burns, the carbon atoms bind with heavy oxygen atoms in the air, creating 2.68 kilograms of invisible CO2 gas. The fuel literally more than triples in weight as it transforms and enters the atmosphere. Crazy, right?
Okay, let's break that down sequentially and actually see the math in action. Step 1. We take the factory generator's activity data, which is 5,000 liters, and we multiply it by our 2.68 emission factor. That cleanly gives us 13,400 kilograms of CO2 equivalent. Step 2. We apply the exact same logic to the logistics fleet. 2,000 liters multiplied by 2.68 gives us 5,360 kilograms. Step 3. To get the final monthly footprint, we just add our different operational sources together. 13,400 from the factory floor plus 5,360 from the road equals a grand total of 18,760 kilograms of CO2 equivalent for ABC Textiles for this specific month.
Now, of course, to make this number standard for annual corporate reporting, we usually talk in metric tons rather than kilograms. 18,760 kilograms is about 18.76 tons. By multiplying that average monthly total by a full 12 months, we arrive at ABC Textiles' final annual Scope 1 footprint of roughly 225 tons of CO2 equivalent per year. To put that into perspective, just to visualize how massive that invisible gas footprint is, 225 tons is roughly equivalent to the weight of 15 fully loaded double-decker buses floating up into the atmosphere every single year just from this one mid-sized factory. Now, a quick caveat, standard organizations do update these specific decimal factors periodically, so always verify the current year's numbers. But this mathematical framework, this is exactly how the calculation functions.
Let's move to our final segment, Section 4, Data Sources and Mistakes, Navigating the Pitfalls of Carbon Accounting. Because, as you've just seen, doing the math on a calculator, that's the easy part. Finding clean data, organizing it, and avoiding critical audit traps is where the real work actually happens. You're going to need to pull your activity data strictly from verifiable internal sources. That means digging up actual physical fuel purchase receipts, reviewing daily generator logbooks, pulling digital vehicle fuel card statements, and checking those HVAC maintenance records. On the flip side, your emission factors must come from trusted external sources to ensure you're audit ready. You'll rely on the GHG Protocol's emission factor library, the IPCC guidelines, or the UK DEFRA database, which, by the way, acts as a fantastic global reference point for international trade. And hey, if you're managing a massive enterprise and want to save some time, know that software platforms like Persephone or Watershed exist specifically to automate this whole tedious mapping process. But before you rush off to calculate your own company's numbers, I really need you to avoid these 4 massive mistakes that routinely trip up businesses. Mistake number 1, using the wrong regional emission factor. Fuel densities and blends actually vary by geography, so make absolutely sure you're looking at the right regional data. Mistake 2, and people always forget this one, completely ignoring those sneaky fugitive emissions, like the AC leaks we talked about earlier. They absolutely count, and auditors definitely look for them. Mistake 3, failing to convert your units properly. Liters, kilograms, and kilowatt hours are not interchangeable in the formula, so double-check your math. And mistake 4, tossing out the physical receipts. Look, if an international auditor for the European CBAM tax or an inspector from the State Bank of Pakistan comes knocking to verify your green credentials, a neat Excel spreadsheet just isn't going to cut it. They will inevitably demand the paper trail to back up your math, and if you don't have it, your calculation is completely void. So to wrap up this explainer, we've successfully walked through the core formula, activity data times emission factor, and we've applied it across stationary, mobile, fugitive, and process emissions.
Now I want you to look closely at your own operations. What is your biggest Scope 1 source today? Is it your backup generator, your delivery fleet, or maybe a heavy factory boiler? I want you to gather those receipts, look at the data, and ask yourself this final, absolutely critical question. If a major international buyer demanded your Scope 1 carbon footprint tomorrow to keep a multi-million-dollar export contract, would your spreadsheet survive the audit?